Another week? Another roller coaster? Interest rates are teasing, rent prices won't chill, and your paycheck? Still playing hide and seek. But don't worry. While the headlines screamed chaos, we sifted through the noise. This is your no-fluff, all-facts, money recap. So you actually know what happened and what it means for your wallet. Big picture. Economy shows mixed signals. Traders on the NYSE floor watch Federal Reserve Chair Jerome Powell's press conference, reflecting Wall Street's cautious mood this week. The U.S. economy sent mixed signals over the past week. In Washington, the Federal Reserve decided to hold interest rates steady at 4.25 to 4.50%, opting not to cut rates yet. Fed officials noted economic growth moderated in the first half, and inflation is somewhat elevated, so they chose to pause and assess incoming data. Notably, 2 Fed members dissented. They actually wanted a rate cut, but Chair Powell stayed non-committal about future moves, saying no decisions about September have been made. This cautious stance cooled off earlier hopes for imminent rate relief. Financial markets reacted swiftly. Traders dialed back bets on a September rate cut, and immediately after the Fed's announcement, Treasury yields ticked up and stocks slipped from recent highs. The dollar even jumped to a 2-month peak, as higher U.S. rates made it more attractive relative to other currencies. Investors seem to realize that more data means more time before any rate cuts, meaning borrowing costs could stay elevated for a while. The message? The Fed is holding firm on inflation, and markets are adjusting to a higher-for-longer rate reality. Meanwhile, fresh economic data underscored some cooling in growth. U.S. job creation slowed sharply in July, with employers adding only 73,000 jobs, well below expectations. The unemployment rate nudged up to 4.2% from 4.1%, and job gains for May and June were revised down by a hefty 258,000 combined. These cracks in the labor market suggest the post-pandemic jobs boom is finally losing steam. In fact, some analysts think the weaker jobs report opens the door to a Fed rate cut in September by showing the economy is cooling. Ironically, last week the Fed was resisting political pressure to cut rates. Now softer employment numbers may do the convincing for them. Inflation remains a pressing concern, however. Prices are still rising at an uncomfortable pace, partly due to global trade tensions. In June, consumer prices rose 0.3%, the most in 5 months, as new import tariffs drove up costs. Economists warn that President Trump's latest tariffs on imported goods are passing through to consumers and nudging inflation higher. That raises the specter of stagflation, tepid growth paired with stubborn prices. It's a tricky spot for the Fed. They welcome signs of a cooling economy, but inflation is not yet defeated. Powell made clear the Fed remains strongly committed to returning inflation to 2%, meaning they won't hesitate to act if prices surge again, even as growth slows. The bottom line for this week's big picture: the economy is cooling but not cold, inflation is slower but sticky, and the Fed is treading carefully to balance these forces. Housing market: high rates cool sales. For sale sign outside a home in Seattle, high mortgage rates have many buyers holding off. America's housing market remains stuck in a late summer slump. New data showed home sales and construction cooling under the weight of high interest rates. Existing home sales fell 2.7% in June, dropping to the lowest pace in 9 months as 7% mortgage rates and economic uncertainty kept buyers on the sidelines. In fact, the median existing house price hit a record $435,300, up 2% YoY, a sign that the few buyers out there are still paying top dollar. But transaction volume is low. Many would-be buyers are simply waiting for lower rates rather than overpaying now. The housing market wrapped up a sluggish first half of 2025 on a down note, one economist noted, predicting weak sales through summer and fall unless conditions improve. Inventory is finally building up a bit. Housing supply jumped 516% from a year ago as unsold listings pile up due to weak demand. Nationally, there are about 4.7 months of supply on the market, which is still slightly below the 5 to 7 months considered healthy, but much improved from the extreme shortage of recent years. In some regions, like parts of Texas, Florida, and the DC area, listings have increased sharply, giving buyers more choices. However, inventory remains scarce in hot markets like New York City. This regional mismatch, glut in some areas, shortage in others, means prices are leveling off. The surge in supply has slowed the pace of house price growth noticeably. In fact, in the new home market, prices are starting to dip. The median new house price in June fell 2.9% year over year to about $402,000. Builders have had to cut prices and offer discounts at the highest rate since 2022 to attract skittish buyers. Home builders are feeling the pain too. Single-family housing starts sank to an 11-month low in June as builders pulled back on new projects. Building permits, a gauge of future construction, also hit a more than 2-year low. with 30-year mortgage rates near 7%. After the Fed's rate pause and trade-driven inflation fears, both builders and buyers are tapping the brakes. People aren't able to buy a house because Powell keeps the rates too high, President Trump complained recently, pressuring the Fed to cut rates and even floating a tax break on home sales to boost demand. But economists caution the Fed will not drop everything and rush to rescue the housing market when inflation is the bigger battle. For now, real estate is a buyer's market in theory. There are more listings and even a few bargains, but buyers still can't afford the financing. It's a stalemate that likely persists until either mortgage rates fall or sellers slash prices more significantly. Consumer debt and credit. America's borrowing balancing act. Even as the economy cooled, Americans' debt levels hit record highs, raising concerns about household finances. Total U.S. household debt now exceeds $18 trillion, with credit cards accounting for over $1.2 trillion, the highest credit card balance ever recorded. In the final quarter of last year, credit card debt jumped by $45 billion, helping push balances above the $1.21 trillion mark for the first time. That mountain of credit card debt has been fueled by high inflation and high interest rates. A toxic combo. Average credit card APRs are hovering around 20%, near an all-time peak. With rates this steep, carrying a balance is more expensive than ever. It's no wonder a new survey found nearly 1 in 4 people with credit card debt believe they may never pay it off. This sense of perpetual debt is especially common for Gen X and Boomers, but even many younger borrowers feel stuck in the red. Why are so many Americans trapped in debt? Surveys point to emergency expenses and everyday costs as the top culprits. Nearly half of cardholders, 46%, carry a balance month to month, slightly fewer than last year. But among those in debt, 60% have been stuck for over a year repaying it. Essentially, a lot of people turn to credit cards to get through pandemic disruptions and inflation spikes, and now they're struggling to climb back out. The data show lower-income households are most likely to rely on credit. 56% of sub-50K earners carry a card balance, but even 1 in 3 high earners carry debt, indicating this is a broad issue. Emergency car repairs or medical bills often start the cycle, then high interest keeps balances growing. As one analyst put it, credit card debt can snowball as soon as it starts rolling down the hill, if not promptly paid. The good news, more Americans usually pay down balances in Q1 after the holidays. And indeed, card balances dipped slightly in early 2025 as some caught up on bills. But with rates so high, any new spending can quickly erase that progress. Other debt segments are flashing warning signs too. Auto loan delinquencies remain elevated across all credit scores, a worrying trend. Americans owe nearly $1.7 trillion in auto loans, and higher car prices have led to more missed payments, especially among subprime borrowers. In fact, auto loan delinquency rates are higher now than before the pandemic at all income levels. People stretched to buy expensive cars during the past 2 years and are now falling behind on payments as other costs mount. By contrast, mortgage delinquencies are still near historic lows, thanks in part to home equity growth and prior refinancing. But housing loans represent much larger balances, so any uptick there would be concerning. For now, banks report that consumer credit health is generally strong. For example, major banks like JP Morgan and Wells Fargo saw fewer loans going bad this quarter and even reduced their reserves for credit losses. Americans are still mostly managing to pay their bills on time, despite higher rates. But bank executives warn they're watching closely. They see potential weakness ahead as the bite of higher tariffs and living costs might hit household budgets in the coming months. On the upside, some Americans are responding to the debt challenge by borrowing smarter. Repayments on credit cards and auto loans have been unexpectedly strong, enabling banks to write off fewer bad debts. And recent data show 46% of cardholders now have a concrete payoff plan, signaling that many are taking steps to become debt-free. Refinancing activity is also picking up in certain areas. A New York Fed survey found households had an easier time getting approved to refinance mortgages or auto loans in June, possibly taking advantage of any dips in rates. Still, with the Fed keeping rates high for now, consumers will need to stay vigilant. The era of cheap money is over, and expensive debt is a drain on spending power. If you have balances, experts advise focusing on paying them down aggressively, a point many Gen Z and millennial consumers seem to be heeding, as we'll see in a later section. In short, America's debt story this week is a balancing act. Record high IOUs on one side, and an urgent push by many to balance the books on the other. Spending trends, frugal fun, and back-to-school blitz. Americans continue to adjust their spending habits in the face of economic pressures. For many, 2023's high prices have forced a new frugality in daily life, especially among Gen Z, teens, and 20-somethings, who are learning to live large on small budgets. A Bank of America survey found that over half of Gen Z adults now spend $0 on dating each month. That's right. Young singles are finding ways to have fun without breaking the bank, often opting for free or low-cost meetups. Among those who do spend on romance, the vast majority keep it modest. 25% of young men and 30% of young women limit dating spend to under $100 a month. It's a significant shift driven by the high cost of living. Gen Z is finding adulting comes with a higher price tag, and they're feeling it, noted Holly O'Neill of Beaufait. To cope, young people are dining out less, shopping at cheaper grocery stores, and sticking to budgets. In fact, 64% of Gen Z say they've cut expenses in the past year, with restaurants and takeout being the first to go. This generation, often stereotyped as free spenders, is now challenging some of the stereotypes by buckling down financially. More than half are boosting their savings, and nearly a quarter are actively paying down debt, showing a level of prudence that might surprise their elders. But frugality doesn't mean no fun. It just means savvy fun. Gen Z and millennials are still spending on experiences and small treat-yourself rewards, even as they budget. 57% of Gen Z treat themselves at least once a week to something small, like a coffee or a little retail splurge, as a pick-me-up. They recognize it's a slippery slope. 59% admit those treats sometimes lead to overspending. But moderate indulgences help keep morale up while sticking to overall financial goals. Also, younger consumers are surprisingly open about money with friends. 2/3 say they don't feel peer pressure to overspend and are perfectly comfortable saying, "I can't afford that," to decline a night out. This financial transparency is a big change from past generations and helps them all save by doing cheaper group activities. And notably, Gen Z places huge value on financial responsibility in relationships. Nearly 80% say a partner being good with money is important to them. So cheap first dates and budget-friendly hangouts aren't just acceptable. They're a new norm that everyone's on board with. Meanwhile, consumers nationwide proved they're still ready to spend when the price is right. The week of July 8-11 saw an online shopping bonanza dubbed Black Friday in Summer. With Amazon's Prime Day extended to 4 days and rival retailers jumping in, Americans splurged on discounted goods and school supplies. Online spending from July 8 and 11 surged by $24.1 billion, blowing past forecasts. Adobe Analytics reported a 30% jump in e-commerce sales during that stretch compared to last year, as shoppers leapt on deep discounts, averaging 11 to 24% off across categories. Retailers positioned Prime Day as the new start of back-to-school shopping season, and it worked. Families stocked up early on clothing, electronics, and dorm essentials. The average U.S. household is expected to spend around $858 on back-to-school this year, slightly less than 2024. So these July deals were a welcome relief for stretched budgets. Mobile shopping led the way. Over 53% of online sales were on smartphones, a record share, as Gen Z and millennials in particular prefer shopping apps over desktops. All told, the strong turnout for summer sales shows that American consumers will spend if you give them a bargain. Big retailers from Amazon and Walmart to Target capitalized by offering bigger apparel and electronics discounts, 20 to 24% off, than last year. Shoppers, in turn, traded up to pricier items they'd normally skip, but only because the deals were too good to pass. That said, clouds are on the horizon for consumer spending. Executives warn that the boost from discounts may be temporary. Tariffs and inflation are starting to pinch wallets, meaning a spending slowdown could hit later this year. Wells Fargo's CEO noted credit card spending growth softened very slightly in Q2, still up year-on-year but decelerating. And Citigroup's leadership predicts consumer spending will cool in the second half of 2025 as higher prices, fueled by tariffs on imports, work their way through the economy. We're already seeing some discretionary categories get hit. For example, international travel, which had been booming, is facing new headwinds. Cross-border trips are down somewhat due to geopolitical tensions and trade spats. Fewer Canadians traveled to the US in June, and Middle East unrest also dampened long-haul tourism. Travel companies aren't alarmed yet, but it shows that wider economic issues are starting to curb consumers' big-ticket spending like vacations. In summary, Americans are getting creative with their money habits, embracing thrift in daily life and pouncing on deals when available. This adaptability has kept spending surprisingly resilient so far, but the true test will come in the fall and holiday season if economic winds turn chillier. Fintech and AI, tech transforms finances. Technology and finance continue to intertwine in fascinating ways this week. Fintech innovations and AI tools are reshaping everything from how we make payments to how we invest. On the industry side, major banks are going all in on artificial intelligence to streamline operations and serve customers. In fact, Goldman Sachs just rolled out a generative AI assistant firm-wide to its employees. About 10,000 Goldman staff were already testing the tool, and now it's officially live company-wide as GSAI Assistant, helping bankers summarize documents, analyze data, and draft reports at lightning speed. Goldman joins a growing list of big banks using AI day-to-day. Citi has deployed an internal chatbot, Citi Assist, to answer employees' policy questions, and even another tool to summarize documents. Morgan Stanley built a GPT-4-powered advisor assistant that helps its financial advisors quickly retrieve research and prep for client meetings. And Bank of America's Erica virtual assistant, a pioneer in this space, continues to help retail banking customers with AI-driven insights into their finances. The takeaway: banks see AI as the new must-have productivity tool. From automating routine tasks to crunching big data, AI is becoming the new UI for banking, an upgrade that can save time and money if done right. Fintech firms are likewise pushing the envelope. This week, CNBC and independent analysts released their annual list of top fintech companies, highlighting innovators in digital banking, payments, and crypto. Several up-and-coming startups, from digital lenders to robo-advisors, earned spots for using tech to improve financial access. For example, neobanks, online-only banks, are thriving by offering app-based services with lower fees, targeting Gen Z and millennial customers frustrated with old-school banks. Digital payment platforms are also seeing robust growth worldwide. In Q2 2025, global fintech venture funding rebounded to $94.6 billion, with payments and AI-driven finance startups leading the charge. Investors are clearly betting that AI plus finance is a winning formula, pouring capital into startups that use machine learning for everything from fraud detection to investment optimization. One striking trend is how AI has filtered down to individual investors, especially younger ones. A new report revealed that 67% of Gen Z crypto traders now use AI-powered trading bots to help manage their portfolios. Based on data from 780,000 users on one exchange, Gen Z is far ahead of older generations in automating their trading strategies with algorithms. These AI bots can execute trades and manage risk 24/7, which appeals to young investors seeking an edge and maybe a bit more sleep at night. In fact, Gen Z traders engaged with AI bots on an average 11 days per month, double the usage of traders over 30. They tend to turn bots on during volatile times. 73% did so during market spikes, and off during calm periods, using AI as a tool for emotional discipline. The result? Those using bots saw 47% fewer panic sell-offs in turbulent markets compared to manual traders. It seems AI is helping young investors remove some fear and greed from their decision-making by sticking to preset strategies. This trend, AI as co-pilot for personal investing, could grow as fintech apps integrate more algorithmic helpers. It's not just crypto either. Interest in AI-driven stock investing tools is on the rise too, with many Gen Z workers viewing AI as a collaborator in daily tasks, financial or otherwise. Of course, with new technology comes new challenges. Regulators are keeping a close eye on fintech and crypto developments. One hot topic is stablecoins, digital coins tied to fiat currency, and their potential to upend traditional payments. In Washington, lawmakers debated the proposed Genius Act, which would establish oversight for stablecoins. Visa and MasterCard are actually working on their own stablecoin-linked products. But some analysts warn that if stablecoins become ubiquitous, they could eliminate the need for payment intermediaries, like the card networks one day. The uncertainty around new regulations, the Genius Act and other crypto bills, has the big payment firms proceeding carefully. In the meantime, both Visa and MasterCard reported strong quarterly profits this week, thanks to resilient consumer spending on their networks. They noted that overall card spending is still rising. Bank of America cards saw a 1.1% uptick in spending, for instance. But they're watching for a potential spending slowdown later in 2025 and any impact from trade tariffs or geopolitical issues on cross-border transactions. Both companies are also exploring crypto and fintech partnerships, ensuring they stay relevant as finance goes increasingly digital. All in all, this week highlighted how tech is transforming finance at every level. High finance, banks rolling out AI assistants to tens of thousands of employees. Everyday finance, young people using AI bots in their investing and budgeting. Payments, fintechs, and even Congress wrestling with the rise of digital currencies and new payment rails. For Gen Z and millennials, these trends are especially relevant. They're quick to adopt new fintech tools. Studies show around 70% of Gen Z started saving by age 20, often via finance apps, and they increasingly expect financial services to be as seamless as Instagram or Spotify. The blending of storytelling and technology in finance, from AI chatbots named Erica to TikTok influencers teaching budgeting, is making money matters more engaging for a new generation. As one commentator quipped, Gen Z has virtually no excuse for financial illiteracy, given the wealth of digital resources at their fingertips. The future of finance is being written in code, and this week showed that future is arriving faster than ever. Student loans and education costs. New rules on the horizon. It was a pivotal week for current and future students, as major changes to student loan programs were set in motion. In Washington, President Trump signed a new tax and spending law that includes a sweeping overhaul of federal student aid. Changes that could affect Gen Z borrowers in the coming years. These reforms, part of a budget deal passed in early July, aim to rein in college debt by limiting how much students and parents can borrow, and by holding colleges more accountable for student outcomes. It's a big shift from the old approach of virtually unlimited loans for grad school. Under the new law, Grad Plus loans will be eliminated starting July 1st, 2026. Graduate students had used Plus loans to cover costs above the standard federal loan limits, but soon they'll face hard caps. For example, borrowing for a master's will be capped at $2,500 per year, or $100K total, and professional degrees like med school at $50K per year. This means future grad students might need to seek scholarships or cheaper programs if costs exceed those limits. Likewise, Parent Plus loans, which let parents borrow for their children's college, will have stricter rules so that colleges can't simply lean on parents to finance any tuition price. The law also streamlines repayment options and curtails some borrower safety nets. For new loans issued after mid-2026, there will be only 2 repayment plans available: a standard fixed plan, 10 to 25 years, and a single income-driven repayment, IDR program that caps payments at 1 to 10% of income and forgives any balance after 30 years. This simplified IDR is actually more generous for some. Low earners could pay just 1% of their income, but it replaces the patchwork of plans we have now. At the same time, the law eliminates certain deferment options that paused payments for hard-pressed borrowers. Economic hardship, deferment, and unemployment deferment will be gone. Instead, borrowers facing trouble must use forbearance, which the law limits to 9 months within any 24-month period. Currently, one could defer or forbear federal loans for up to 3 years, so the safety net is being pulled back. The rationale is to prevent balances from ballooning unseen, since interest accrues during these pauses and can capitalize. But critics worry it could hurt those who genuinely can't pay for a time. In short, future borrowers will have to resume payments sooner and won't be able to postpone repayment as easily as before. Another significant change is how Pell Grants, the main grant aid for low-income undergrads, will be awarded. Traditionally, Pell is given first, then any scholarships or other aid stack on top. Under the new law, Pell Grants become last dollar aid. This means if a student wins any scholarships or institutional aid, those will count before Pell, potentially reducing or even eliminating their Pell Grant eligibility. For example, if a low-income student gets a private scholarship, it might now offset their Pell Grant amount dollar for dollar. The intent is to avoid over-awarding aid, but the worry is some needy students could lose out on free federal money if they secure outside scholarships. Finally, the law introduces a form of college accountability for student outcomes. It creates metrics for low-earning programs. If a college program's graduates consistently earn less than a typical high school grad, that program could become ineligible for federal loans. This is an aggressive step to pressure colleges, especially certain majors or for-profit programs, to either improve their results or shut down programs that leave students with debt and low pay. It builds on the Obama-era gainful employment rule, reviving it with even stricter standards tied to graduate earnings. For Gen Z considering college or grad school, this could actually be a boon. Degrees with poor return on investment might get flagged or ended, steering students toward better value paths. However, some educators fear it may discourage colleges from offering programs that lead to vital but lower-paying jobs, like social work or teaching, unless adjustments are made. These reforms come on the heels of other major student loan news. Just a few weeks ago, the Supreme Court definitively struck down President Biden's student debt relief plan, which would have canceled up to $20K per borrower for millions of people. That June 30th ruling, in a 6-3 decision, killed the $430 billion forgiveness proposal, dashing many borrowers' hopes of instant debt reduction. Since then, Biden's Department of Education pivoted to other relief measures, like adjusting income-driven plan counts to forgive older debts. But no large-scale cancellation is on the table anymore. Meanwhile, student loan interest started accruing again on September 1st, 2023, after a long pandemic pause, and monthly payments officially resumed that October. So as of mid-2025, borrowers are back in repayment and feeling the squeeze of another bill each month. The Biden administration did launch a new SAVE repayment plan, saving on a valuable education, to replace PAYE, repay-IE, cutting payments for many and shielding unpaid interest. But that too will sunset once the newly legislated single IDR plan begins in 2026. It's been a confusing time, but one thing is clear. Going forward, borrowing for college won't be as easy as it was for previous generations. Loan limits and higher education funding are now front and center in policy debates. If you're a Gen Z student, you'll need to plan more carefully, maximizing scholarships, perhaps working more during school, and being mindful of the earning prospects of your chosen field. On a brighter note, the focus on value could spur universities to control tuition costs and better support grads in finding good-paying jobs. The bank of mom and dad might stay open a little longer too. Some parents are already expecting they'll need to contribute more, given these new borrowing caps. Ultimately, the goal of these changes is to prevent young Americans from winding up with crushing debt. This week's actions show the government is willing to shake up the status quo to get there, and Gen Z will be the first cohort to experience this new student loan landscape. If you enjoyed this recap and learned something new, hit that like button and subscribe to Personal Finance Time for weekly insights. Have questions or a topic you want covered next week? Drop a comment below. We're here to help you master your money. And for even deeper dives into personal finance trends, visit PersonalFinanceTime.com for articles, tips, and resources tailored to Gen Z and young adults. Remember to share this video with a friend who needs a financial update. Let's grow our community of savvy savers and investors. Join us and take charge of your financial future. Subscribe now and turn on notifications so you never miss an episode.